What's up, guys? How's it going, fellow pit traders? Uh, this is a little bit of a weird one this week. We couldn't get together for a Thursday pit stream, but it's been requested in the pit that I do a little bit of scalping school, kind of go over some of the concepts I use to scalp cryptocurrencies. So that's what I'm going to be doing here today. I've got a list of cool things to go over, but if you have, if you want me to cover anything, you have any questions, you want me to look at any assets, please let us know in the chat. Coach Popovic will be flagging me if there's anything we need to discuss. So before I get started, I wanted to mention something is that, it's been a thing on the pitch stream that you should just open a short on Thursday at 1 p.m. when we go live, because BTC kind of always nukes during Thursday's stream. And so I asked Bard, which is Google's AI assistant, what's the volatility of Bitcoin on Thursdays from 1 to 2 p.m. versus its average hourly volatility. Turns out it's the most volatile on Thursdays at 1 to 2 p.m. I went a little bit further and asked, what is the most volatile hour of any day? Turns out it's Thursdays, 1 to 2 p.m. And it's also the hour in which we get the most downside on Bitcoin. So just a little bit of proof positive for the old short Thursday stream narrative. But let's get into it. Coach, if you want to flip to a chart here, let's go over some things. So I want to start off with a little bit of theory here, just to kind of theory craft, get everyone's head in the right place when it comes to understanding price, which is that basically I just want to state at the top here that price mostly ranges. Trends are exceedingly rare. They just don't really happen. Like this right here, you're looking at, what are you looking at? Maybe 1, 2, 3, 4, 5, 6, 7 months of just nonstop upwards price action for the most part on the monthly. On the weekly, if you go to that level, it's actually more like half of that. And then we ranged, and then we got another trending move. But you'll notice on this chart that, like, how much time did we spend trending? Very rare to see it trending. Okay, mostly price just ranges. And if you look here, when's the last time we got an expansion of this range? Let's just mark out range high, which we deviated at the top of the last bull run. And let's mark out, maybe let's go even here, range low, right? A range that was set in about a 7-month period has not yet been broken. We have not yet had expansion of this range that was set across 7 months in 2020. So you can see that mostly price just stays in a range. And that's an important concept to kind of have down when you're trading, is that, like, if you're sitting here trying to go for these moves, you're going to be upset a lot of the time, because it just very, very rarely trends. You very rarely get range expansion, and trying to trade based on it is not the best idea, IMO. There are low time frame ranges, there are high time frame ranges like the one we just marked out here. But, ultimately all trending is just expansion of a range. And usually it sets a new range, and usually you stay in that range for a lot longer than it took to actually expand. Now, traders get paid to be correct about direction over distance. So we get paid when we have the direction correct over the distance that it actually moves in that direction. So if you're expecting it to, like, go here, do this, right? You're probably not going to be correct. And since most direction that we can cover, most distance we can cover is in a very tight range, it makes more sense to get good at trading the tight ranges. Because if you only trade these range expansions, you don't get to trade very often, and you don't get to be correct very often. So that's why I think it's of utmost importance that people know how to trade ranges, tight ranges. And we can look and just mark out, like, when were we ranging on this chart, right? I mean, most of this was just very rangy price action. Same, I mean, I guess we could expand that out to here. This was very rangy, this, very rangy. So you can see that like most of your opportunities on this chart lie within tight ranges or relatively reasonably tight ranges. So that's where I wanted to sort of set our mentality at the top of the stream, is that like if you can get good at trading those ranges, it doesn't really matter about the trending moves. If you catch them, that's nice. But you'll find that if you were to uncoil this price line, that most of that distance is in a tight range, ping-ponging back and forth. So knowing how to spot reversals, knowing how to, understand where you should be taking profit, that's all really important. So most distance is in tight ranges. If you learn how to make money with that, you will unlock 99% of the price action on this chart. If you rely only on trending moves, in my opinion, not everyone trades like this, but in my opinion, you're going to be sitting on your hands a lot of the time. You're going to be wrong a lot longer. Another thing that's important to understand is that it's easier to be right about low time frame moves than high time frame moves. It's easier to be right about what's going to happen in the next 5 minutes than it is to be right about what's going to happen in the next 5 years or 5 months or 5 weeks. So your expected value, once you get a little bit good at spotting these things, goes way up. Because if you're expecting, Bitcoin to 39K in the next 4 weeks, like you're very likely to be incorrect about your target, about your time frame, about your direction. But if you're just trying to catch a 1% move in the next 5 minutes, your likelihood of being correct about that goes way up. And if you can only make trades when you have a high expected value, you have a high likelihood of being correct, then you're going to be in a lot better place. So let's go over price action trading, because everything really starts with price action. We're going to go over indicators. We're going to go over some other things you can fancy it up with. But most things start with price action. So let's map out some of our ranges, okay? For example, let's map out this range. We have a range high here. We have a range low. Maybe we could call that a deviation, and we map this as our range low. What do we do? What got everyone scared last week, right? We went below the range low on kind of, wherever you draw it. You could really say we went below it. What's got everyone excited / not yet ready to say Goblin Town? We went back above the range, okay? And usually, and I'll just add this here, when you go below or above a range and then close back inside, you're highly likely to rotate to the other end of the range, which is why some people are calling for, 30K or 29, 3 or whatever. Because very often when you close back inside here, you're very likely to just go here, okay? So that's what you kind of got to know about ranges. And almost all price action trading is based off of a range. To give you a very clear example of that, this is our continuation cluster from the nukes, right? Let's mark out the high. Let's mark out the low. Let's say this is our like sort of objective low. This was a very tight range in which price traded during 2022, okay? And this is also where people expected this rally to stop, okay? So a key concept to understand is you want to be looking for these high time frame ranges. You want to understand when price is trading within them and what that might mean. And then you want to know how to map out your ranges, right? So if we were to consider that a range, 2860 to 32,148, then we might say that around here is our midpoint, okay? So range high, range low, midpoint. And this was a godly deviation of the mid. What's a deviation? Deviation is just when price goes above a level or below a level and then reverses and goes back to the other side of the level. So this deviation, if you had caught it, gets you all of this price distance, right? I caught this deviation, but I cut it pretty early. That's just to say that like price action trading, the way you can make money and be successful as a trader without really fancying it up too much is just knowing really well how to map out ranges and then how to spot, especially when price deviates a portion of the range, okay? So right now you could be saying, all right, we're below this range. If we go back up here and test, but we're unable to clear back above it, and then we start just kind of moving back down, that might be a really good short. Now, why? Why is it a good short? Because invalidation is cheap. You really only want to be taking trades where your invalidation is really cheap. And that's why this was a great trade, and all deviations are really great trades. Why? Because if we were to take a trade off of a deviation, here's what it ends up looking like, risk to reward wise. Okay. If you can just do this, invalidation's very cheap and your distance is much larger than your invalidation. So here we've got a 5-to-1 risk to reward ratio. Then you're golden. You can be wrong, 3 out of 5 times and still make money. So that's really where you want to spot, is where is invalidation cheap? And that's why range trading is really great, because you'll often end up in places where invalidation is really cheap. Let's say we went back above here and then we close back below. That would look like, this. And it doesn't matter if you're right or wrong. Okay. That's the main point, is that, like, if you're able to spot places to do business, they make sense, and your invalidation is really cheap, then it doesn't really matter if you're right or wrong. You can be wrong a lot and still be fine. Now, getting good at mapping out ranges, like, that's its own thing. And they're very subjective, right? Where are you gonna put your range high? Where are you gonna put your range low? But, like, let's say we're approaching this chart, okay, on the daily. There's like a high time. Let's go weekly, actually, for like a high time frame range. Okay, so we have our range high here. We have our range low. Let's say it's down here and that this was a deviation. And then let's say that this is our mid. Okay. If we were to close back below this line at 25,053, you could take a trade. You could take a short. Why? Because your invalidation is very cheap. You don't want to see it getting back above that range high. And your targets, mid-range and range bottom, are very, far away from where that invalidation is. So you can end up, clocking some good risk to reward. So mapping out these ranges, I think it's super important. And I think it should be the fundamental basis of, like, almost all your trading should be a range, because even if you were, like, in the heat of a bull market, right? It doesn't matter. You're still kind of in a high time frame range. Look at this range, right? This is objectively our range. Let's even set it from the halving, okay? Here's where we were at the halving. This is our range. Let's say that, like, this is mid right here. What do we get up here, right? And there are traders who caught this godly trade. It's the bull market in reverse. They caught the range deviation at the very high of the range, and they were able to short it all the way back down to the mid, maybe even down to these lows here. Okay. So that's why deviations are so great. That's why ranges are so great. It's because price moves in a range. It just ranges. Your trending moves, they're exceedingly rare. They basically don't happen. And you kind of know when they happen. Hey, here's a halving. We're probably going to get a trending move and a range expansion. Okay. So as you get comfortable with trading ranges, you'll get more comfortable with, understanding range expansion, using your indicators to understand when that might happen. But you can't really go wrong assuming you're in a range, spotting it, mapping it out, and waiting for a place to do business. Range high, range low, or range mid. Now, if you're just god awful at this and you have no idea how to do it, here's a great way to look at it. And I'll show you. I'll map this out for you. I have it on another chart, but I think it makes sense to do it here as well. So Monday is the opening of the trading week, right? It sets the beginning of our weekly candle. It's a very important day. It's the cash open after the weekend. So a lot of volume is traded on Mondays and a lot of business is done. This is our Monday candle. Let's map out the high. Let's map out the low. Then let's map out the daily open and the daily close right here. This is a range. Okay. Now let's drop it down to the lower time frames. And let's add some labels here, actually. Monday high. Monday close. Monday open. and Monday low. Now you'll be glad to know that my co-host RT, our favorite, took this trade today. What did we do? After, let's see, Monday's here, right? So we expanded outside of the Monday range. Is this last Monday that I took this off of? Damn it. Let me just double check that real quick. No, I took it off the right Monday. Okay, cool. So what happened? Price went above Monday high, and then it closed back down below it. That's a short. Where's invalidation? Let's map it out. You don't want to see it getting above the expansion candle, right? Because then it's just likely to go higher. Where's your target? Monday low if you want to be aggressive, or Monday open if you want to be a little bit safer, or mid-range. You could find the mid of this and just put it there. Any of those trades has good risk to reward, okay? So that's the Monday open, high, low, close strategy. Basically, when price interacts with any of these levels, you want to take the trade that makes sense. And then what happened? Price did a little bit of business underneath Monday's low, and then this morning it reclaimed it. RT took the trigger up here. First take profit at Monday open, second at Monday close, third at Monday high. Now, what did I do? Okay, I missed that trade. But I took the deviation of Monday close. What happened? We went all the way up to Monday close. We got above it. We got rejected off of the previous Monday's open. Then we came back below Monday close. So I'm going to take the trade. Invalidation was originally up here because I don't want to see it go back above that previous Monday open. And then I tightened it up as I saw that it was kind of coming back to my entry. I didn't want to take a big loss on it if I was wrong. What's happening now? What's happening right now? Right? 1 to 2 p.m., guys, the goated hour. So that's the Monday range trading strategy. It's been absolutely goated over the last week and this week. It's provided a lot of great trades. So if you don't know anything about range trading, you can get pretty familiar with it just by using this strategy. Every Tuesday, come to your chart, map out these levels, and then wait for price to interact with them. Closing back above Monday's low is a long. Closing back below, and this is not financial advice, obviously, but closing back below Monday's high is a short, okay? And my targets are already mapped out for me. Now, if we were to get, we're filling a fair value gap. I'm going to talk about those in a second. But if we were to get back above Monday's open right now, I'd cut this trade, okay? Wouldn't like it. So that's what I wanted to go over with range trading and the Monday open, high, low, close range. We went over range deviations, right? Over, under. We went over Monday close, then we went back under it. Over unders are probably like 70% of my trades. Is just, shorting over unders because they're just really easy. Your invalidation is above the level it went back under. And so it's a very easy trade to take. Let me just make sure I'm monitoring chat. So if anyone asks anything, I'm here to answer it. All right, cool. So we went over all that. Now, most of my trading is ranging, right? I told you that. I'm currently in this BTC short. I'm also in this render short that I want to show you guys. So all morning, and these are FVGs. I'll go over them in a second. So this chart's a little bit messy, but all morning we were trading above this important level of 2.799, which I think is a previous important level. Yeah, it was range bottom here. And then trading under 2.847. We got a massive open interest increase, and we went up here and we spiked, and then we went back down, closed back down below 2.847. What is that for me? It's a short, right? Here's what it looks like. Okay. And I've got a bunch of levels mapped out here. I expect it to fill this 1 hour FVG. It's filled all these other FVGs. We'll go over those in a second. That's what it looks like. Okay. So how do we add confluence to this? What if we want to be more sure about our range plays when we're taking them? There's a number of different things you can use. You guys are probably already familiar with RSI, right? I use RSI on very low time frames to spot where, people might be getting over their skis. To give you an example, here, this is the 1 minute time frame. It's what I'm mostly on. And the great thing about low time frame RSI is relative strength index. It's just going to show you sort of the strength of the price moves. Usually you're going to get a divergence at price extremes, usually at range extremes, which is really cool. So what happened here? We went up, we formed a high, formed a low, formed another high. RSI makes its highest peak. We come back down and we form a higher high on price, but a lower high on RSI. And that happened to be located at the range high, right? So that's some nice confluence for understanding if you're correct here. Finally, we spiked above the range and we formed a lower high on RSI. So that tells you this move's kind of, it's getting past its prime and it's probably going to revert back down to the downside. Once we close back inside the range, we rotated to the other end, as is typical to happen. Okay. Now, that is RSI, using RSI to add confluence. You can also use high time frame RSI. You know, I'm sure that there's a deviate. Yeah, there is a deviate or a divergence here. So we formed a high on price, formed a higher high, formed a higher high. But what is RSI doing? It's going lower. Okay. Just tells you it's running out of steam. Okay. So that's RSI. We can also use order flow and footprints. I'm not going to make you well educated about order flow or footprints on this stream. You know, probably obviously it's a very big topic to go into, but this is a bid ask profile. These are candles. These are 30-minute price candles, just like you see on a candlestick chart. But what it's showing you is actually the amount of bids, passive bid orders that were filled, meaning someone market sold into someone's bid, or asks that were filled, meaning someone market bought into someone's resting asks. You know, markets are made up of market orders and limit orders. Limit orders are passive, they're resting liquidity. Market orders are active liquidity. Okay. So this will show you how many people market bought, how many people market sold. Okay. Now, the thing you can see here is that if we're looking at this 4-hour set of candles, or even we can go to a 6-hour to get it all in one swipe. What's happening here? We have just a shitload of people who market bought like up at this level. And what is price now doing? It's going down. What does that mean they're going to have to do? They now have long positions at the top of a 6-hour candle. What are they going to have to do? They're going to have to close out, right? And that's going to add fuel to the downside. Okay. So you can use these types of trap setups to understand. And here's a delta profile, which should show it better. This is a P shape, right? That usually means, okay, this is going down. We also have B shapes. Okay. And so you get trapped orders down here. If I composite all this, I'm sure there's a shitload of volume at these lows. And once you start pushing up, they've got to close out. So it can add fuel to the fire. I'm not going to go over all the different types of footprints. There's market profile, there's delta profile, there's volume profile, there's bid ask profile, there's value areas. You know, that's probably for another stream. I just say you can use this to add confluence. If you were short BTC here, you saw all this volume building at the highs and it's at an important level and it's deviating, like, you know, you can feel pretty safe in your short. Same thing for longs. So let's add some more confluence. Let's look at some indicators I like to use. We have Lela DC by Insilico. What this does is it measures exhaustion candles. It's a complicated process how it works, so I'm not going to go over that, but it should paint some levels for you where it thinks things are exhausted. And you see here on the 15M, it did a beautiful job. It showed where price was capped here, and then it caught where price was capped here, and it doesn't repaint. So you know that it's doing its job really well. You might wait, you know, let's say you're short render here. You might wait till it paints exhaustion at the bottom before you close out the short. So that's something I like to use sometimes. The one place where it was really goated was this, I think it painted a weekly high. Yeah. I mean, there's a weekly bottom down here at the exact Pico bottom, and there's a weekly high up here around where price kind of topped out. So definitely a goated indicator buying silico. So you know it's good. Another thing I like to use is bands. You have VWAP bands, which is volume weighted average price bands. My favorites are Cuban's reversion bands, and I use these on a low time frame. Oh, yeah, there's a lot going on this chart. Let's maybe try it over here. So here you can see on the 1M, the Cuban's reversion bands. I like to use them with these settings, but they're basically showing you a lag in price action where it should be able to capture price in the middle the whole time. When it's getting into the bands, it means it's an extreme. If that happens to be confluent with one of your range levels, you might take it, right? You might take a long here if you decide, okay, it's deviating a range low and it's in the bands, right? You can even use higher time frame bands for added confluence. But, you know, bands are tough. You really want to use them on more ranging days like this. Like yesterday was a lot better for bands. Why? Because you got so many trades off of them. Okay. Slams into the bands short, you know, take profit at the median basis or at the bottom again, slams into the bands long, slams into the bands again. You probably had to martingale to get out here. Long, long, short, long, short. You see what I'm saying? So on ranging days, in ranging environments, usually a boring day of the week is when you can use bands, you know, for a lot of maximum efficiency. I love days like those when it's just ranging because I can get a lot of trades off. This is another indicator, KCB, which is Keltner channel bands. They're really useful. This one's jazzed up and it basically shows you how long, using color, how long it's been overextended. And when it finally hits the basis again, that color will stop. So the redder it gets here, the more your short should be playing out. The greener it gets here, the more your long should be playing out. So those are kind of cool. But you really only want to use bands on ranging days. And if you don't know how to identify the environment you're in, then I wouldn't just like slap on some bands and start using them because you might be asking for trouble. So that's bands. Now let's go to fair value gaps, which I've been using a lot lately with also open interest. So let's identify what's a fair value gap? So anytime that you get a candle on any of the time frames, and let's just go to this one here, this 1 hour fair value gap. We have a candle here that had a big expansive move. The bottom wick of the next candle stops here. The top wick of the previous candle stops here. So in between, we have just this naked candle body where no wicks overlap. And the thing about that is that they just don't exist. Okay. It's very rare on a price chart for a naked candle body to exist for very long without getting eaten into. Okay. So this is a 1 hour FVG because the bottom wick and the top wick of the neighboring candles do not overlap here. So this whole time that price was doing business up here, I expected it to eventually come back down and tap this FVG. FVGs don't get tapped, don't get filled, they get tapped. So, you know, price did technically make its way into this FVG. So it's invalid now, right? It's done. I can move it off. So I use FVGs a lot. I paint them all over the chart. Just because they're just unlikely to exist. They typically get filled, usually pretty quickly as well. Like right here, just if we were, let's just do one right now, right? We have a fair value gap right here. 5 minute fair value gap. Now I have templates drawn out to make this a lot quicker and easier for me. There's our 5 minute FVG. I expect it to get tapped at some point. It's gonna, you know, price is gonna visit it. You know, sometimes you get a range expansion away from the level and they just don't get filled for months, but they're gonna get filled. Why? Because price just ranges. It doesn't expand away and never revisit a level. It ranges. Okay. I think it's a very important concept to get through your head because it took a long time for me to get that through my head. You have two types of, well, you have many types of FVGs because you have different time frames, right? But you have two types of FVGs, mid candle and wick. Okay. So this 15-minute fair value gap right here, you can see the neighboring candle only made it this high, and the next neighboring candle is way lower. So this is our fair value gap. Okay. This is on a wick. So usually if you see price tweezer top, like on the 5M, let's go to the 1M. This doesn't exist on the 1M, right? But we see kind of a tweezer top here. So if we go up in time frame until the last place where we can see it, because I don't think it's on the 30M, it's even larger. So let's actually fix that. This is now a 30-minute fair value gap. The difference between the time frames, I tend to believe, and I don't have any data on this or necessarily could like say confidently that it's true. I tend to believe that the higher the time frame, the fair value gap, the stronger a magnet it is for price. It's eventually going to get filled, because the higher you go up in time, the less likely it is that you'll find a fair value gap somewhere. Now, I scalp with these on the 1 minute time frame. Okay, so price just kind of filled all of my FVGs to the downside that I was waiting for. So I imagine there's a bigger one down here, this 4-hour FVG. So we could nuke that low, but it's unlikely that we do that from this price. I would assume that it goes back up, but I have this chart open where I'm constantly adding these FVGs, and I'm using large orders on render to scalp it. And I'm also looking at funding. Right now, funding is negative, which means that we're overloaded on shorts, or we have a very high spot demand with very low perp demand. There's a number of different ways you can get negative funding, but negative funding is uncommon, and it's less safe to short when funding is negative. What I really use a lot is open interest. I use open interest on Binance, and you'll find that open interest tends to precede major price moves on Nance. Let me find where I was. Yeah. Okay. So here's what happened last night. I actually helped JC get a great trade off of this. I'm trying to find it. At some point, OI started ramping up, but price wasn't following it. Specifically here, OI is continuing to ramp, but price is going down. Then OI dropped off a cliff for a little bit, but eventually it had that move, right? OI is ramping up, and then it eventually just mooned up into this range that we've been in all day. Now we're getting range expansion, right? We're kind of below the range lows, so you can assume that we're going to expand down into a new range. But just to say that I use OI because it typically leads price a little bit. If I see OI dropping, for instance, on this spike, right? When price spikes above a range level, you're going to look for short liquidations. Why? Because a bunch of people were short and they just got wrecked. You should see confluent with that a drop in open interest because they were short, so they were a portion of the open interest. You should also see longs closing out. So you see short liquidations, OI dropping, we're deviating back below a level. That's a lot of confluence for a short, okay? More confluence than you should need. So that's how I kind of use open interest in funding to get a good look at like what I should be doing on lower time frames. You can see here like OI is kind of finding a bottom here. We're above the lowest level of open interest right now, but price is still dropping. If this starts to build back up, I would start entertaining closing my shorts and looking for longs. Okay. So that's what I got to say about that. The last thing I'll say is execution. Okay. We have to map out our high time frame levels so that and set alerts and be ready, because when we get those deviations, you don't want to be taking the trade after the deviations already happened. Like let's say you saw this and you had this level painted, but you weren't at your desk and now price is down here. The problem with that is that your invalidation is way up here. So you missed the trade. But in my earlier days trading, I would just be like, oh, it's going in the right direction. Like I'll take it. The problem with that is that like, you can't do that 1,000 times. Can't do that 1,000 times. For instance, let's say you took it here and then it went down here and now it's spiked back up. I got it from here, so I'm way less worried when it spikes back up here. I continued to drop during this spike as well, so I'm less worried for that reason. But the further away from the ideal or optimal trade entry that you take the trade, the more likely prone you are to not only getting invalidated for like a high cost, but also just getting scared out of your trade, right? So you want to be comfy, and comfiness comes with proper execution. So, on an off day when you're not trading, go through your charts, go through all your favorite alts, go through everything on your watch list, map out your weekly ranges, and then bring it down to the daily. Look for daily ranges and just leave that evidence on the chart for yourself where you want to do business, and then set alerts where you want to do business. Have your alerts connected to your phone. That way you're always at the ready when price does something that's interesting to you from a trading perspective. Okay. And then be good with execution. The way to be good with execution is to already know where your invalidation is and already know where your target is before you take the trade. Okay. Now, when I'm scalping, that's less likely. I'm not going to set, stop loss and risk to reward, diagrams when I'm scalping, because I could take 5 trades in a 5-minute period. But if you have your ranges set and you know where you want to do business and you're doing higher time frame moves, you want to have all that planned out in advance. The reason being is just like the comfiness. Okay. The comfiness is the most important thing. You want to be comfy in your trades so that you don't get shook out of them, or you don't end up paying way too much to get invalidated. So I'll just say that execution is incredibly important. If you're scalping, consider using a terminal. Okay. Terminals are a great, there's a number of different terminals. There's Silico, there's Teal Street, there's Quant Tower, there's a bunch of them. And you can connect it up to your exchange. If you got, most of them connect with KuCoin and Bybit and Binance. So whatever your exchange is, you should be able to find a terminal. And what it allows you to do is click trade. So you can set, like let's say you set an average order amount. You can just click on the chart for a limit order there. And when price goes up into it, it'll trigger your limit order. So that's, one way to get better at execution. So that's all I wanted to go over in terms of my my list of things. I'd love to answer some questions or check out some charts if y'all want, or we can wrap it up here. But that's my presentation. That's all I wanted to go over. Let me just actually check on this render short real quick. What's going on here? I mean, OI is dropping off of a cliff, so I'm going to keep this open for now. Coach is asking in the pit. Thank you so much, Coach. All right, cool. Well, that accelerated quickly on render. Let's check out BTC and see how that's doing. Yeah. How many hours per day do I trade usually, and how many days per week? I trade actually less rare than you might think, or more rare than you might think. Usually I'm trading the mornings, and then sometimes in the evenings I'll scalp on my phone a little bit, although I have a lower success rate when I'm scalping on my phone. Days per week is I would say like 4 to 5. But a lot of the time when I don't have, the faculties to be proper with execution, maybe I'm on my phone, or maybe I got stuff to do that day, I'll just do some like paper trading to be honest. My main bag, the bag that I plan to deploy for the next bull market, is locked away safely. Okay. And I've really just been working on a challenge account. So I've taken a challenge account from 2K to about 50K, just scalping, in my off time. Over the last 3 months, or mid-February, I think is when I started this challenge account, because I didn't want to blow up, my main funds just having fun. So I'll take any opportunity to get better, but I'm limited by, when I can be at the desk with all of my data pulled up. And that's when I do best. So if I can't do that, I'll be paper trading just to sharpen the skills and get better. I hope that answers your question. Damn, Bitcoin is dropping, guys. Yeah, we like it. So what we're looking for here, this is a 4-hour fair value gap on Bitcoin. You can see it right here, and it's filling. It's being filled aggressively. We can find another one down here, and maybe this gets filled. Let's mark that out. But yeah, I've recently found fair value gaps to be incredibly useful. You know, they aren't unique. Like, this is an ICT trading concept. ICT is inner circle trading. It's like some trading school for Forex people. And a lot of people on crypto Twitter use it. Like Follis is a ICT guy. So ICT is very common. But it's like Abe Trade of Trading Riot has complained that like ICT is just regurgitated concepts from other areas of trading that they've given a fancy name to, and, you know, acted like it's something different, which is kind of technically true, because fair value gaps are also thin auctions. What is a thin auction? Let's check it out, guys. Here is our fair value gap, pretty much. Like, it's pretty much it right there. You notice how much thicker everything is except for this candle body? It's a thin auction. Not a whole lot of business was done on the way up. There wasn't enough time. And so thin auctions typically get revisited and filled. And so that's why, you know, fair value gap, thin auction, imbalance, inefficiency, they're all kind of the same concept. But I found fair value gaps to be incredibly useful, because not all fair value gaps are thin auctions. Like, you know, you could have, this could be meaty, but just the fact that it went through it really quickly, they tend to get filled. Like, they tend to get tapped. You're very, like, you know, you're very unlikely to just see, like, it's very unlikely that we'll never tap these FVGs, right? Ever again. That's just, it's like a 1 in 10,000, you know, or a million shot, right? It's very, very exceedingly unlikely. So it might not be the case that like traders need price to revisit this fair value gap so they can get their order filled. Like, that's, you know, like, people will add that kind of theory into the concepts and be like, well, that doesn't seem to make any sense. Let's say you have a fair value gap from ages ago, and it's just like, no traders are sitting around waiting for this to happen. It's a year ago. It's from 2022. Well, that's not really why we use fair value gaps. We use them just because they are highly statistically unlikely to exist. Okay. And even this, I'm sure there's fair value gaps below that never have been filled, but there's many millions more that did get filled. So, like, yes, they do happen. There's probably some down here somewhere that just never got filled, but they're just very unlikely to happen. That's, you know, one out of many, many millions. But let's say this right here is a daily FVG. Let's do, oh, I don't have that. 1D FVG. There is a 1-day FVG at 69K, guys. It's true. I highly anticipate that it will be filled eventually. Let's extend that, right? I'm sure it's on the weekly, it's even larger. Let's check that out. Yeah. Yeah, it is. Let's move this around here. Very cool. Yeah, they just don't exist. That's why we use them. We use them because the likelihood of them continuing to exist is exceedingly low. So yeah. Anyways, I think that's it for today, guys. I hope that was helpful in any way. I'm glad I could fill in here for our Thursday stream and still get you guys something that hopefully is useful to you. And I think I'm going to call it a wrap here. So thank you guys so much for joining. If you have any questions or follow-ups, join the pit. Go to hxro.com, hit the community tab, join the Discord. I'm in there pretty constantly. So if you have any follow-up questions to this presentation, I'll be in there for that. I'm glad you dug it, Lizzie May. Thank you so much. And I will see you guys next week, hopefully, for a regular pitch stream when price will nuke once again. Peace out, y'all.